Welcome back. You're watching Stock Watch with me, Nati Guma, and joining me to take your stock-related questions tonight are Roy Mutooni from Sanlam Investments and Devin Shutte from the Rebay Group. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag StockWatch. Thank you for your time, gents. Is there anything specific, Devin, that's responsible for the sour sentiment that we're seeing in the markets, and also just the rand continuing with its weakness against the dollar?
Yeah, I'm not sure if there's anything specific. I think as we hear those U.S. elections, I think there is going to be heightened uncertainty leading up to that, and what that could mean for markets. I think also the dollar has had a bit of a resurgence last week. They had some really good retail sales number out of the U.S. that seemed to pop it up a bit there. And then possibly the predictions of shallower cuts from the Federal Reserve, and maybe even us could be tying into that. So yeah, nothing overly specific. I think broadly, if we look back by maybe a week, markets have generally been more risk on. But as you say today, soured a little bit. But yeah, maybe it was just a rainy Monday morning like it was here in KZN. I'm not sure.
Yeah, it was raining yesterday in Joburg as well. Roy, just on that, because I would have expected maybe the Chinese cutting off the 1-year and 5-year loan prime rates to actually lift the mood of the markets, and maybe even the rand, especially after the data, the GDP, retail sales, industrial production that did surprise to the upside last week. But has that just not been enough?
Look, the big thing here, I think, is the dollar strengthened considerably. The dollar index has gone from, I think, 101 to about 103, and that's on the back of higher loan bond yields. We're back over 4%. So, and also remember, the markets have really rallied. You've had consecutive records across the board, and now we're going into a very critical earnings season, which would either affirm valuations or just confirm that we're in a bubble pretty much.
Yeah.
So I think it's basically a breather that markets have taken, a shift back to risk off, to look at these results, and to also think about why yields have gone that high, because that is definitely a concern. We all thought with the soft landing, yields would come down, short-end yields would also be lowered, and would start a whole new cycle. But now it just seems that I think people are concerned, sitting on the sidelines, waiting to see how the U.S. election pans. So I think it's a bunch of all of those narratives coming together, and nothing really positive, nothing really standing out on the positive side.
All right. Well, gents, let's go into one of the big talking points there in the mining space, and that is, of course, the appearance of that BHP might come in for a second bid for Anglo American. And here's a question. It appears that BHP will make a further bid for Anglo. Is it wise to sell Anglo or hold if the offer is accepted? A lot of conversations that I've been having with investment professionals is that whether BHP comes in or not, Anglo is still a good hold. How do you trade, the looming bid here, Devin?
Yeah, look, there's still quite a bit of uncertainty. Remember, this is potentially the second bid. We haven't had anything formal yet. I mean, we have had the BHP CEO out in South Africa meeting with government officials, so that that indicates that something is in the offering. But also remember that it's probably not going to happen before the Anglo American unbundles its platinum company, Amplats. So I think this could take a lot longer than expected. It is clear BHP is after Anglo, and specifically those copper assets, which currently make up about 13% of group revenue there. That's really the jewel they're after there. So, to the viewer's question, what should they do? It's very difficult to trade this merger and acquisition activity just because it's highly uncertain. My sense is that there are some very significant assets in the Anglo American stable that are worth owning, and if you happen to get a bid premium because BHP really does want to pay up for that, great. But yeah, I'd be sitting tight and holding my shares.
Okay, all right. Well, a second question from another viewer. It seems that the Anglo American executive is adamant on ensuring they have a job when when a BHP inevitably places another bid. How do shareholders position themselves to maximize off the future transactions? A comment there: for the sake of the SA mining sector and the SA economy as a whole, I really do hope that BHP are made to buy up everything and incentivized to make the Anglo assets work. The transaction is screaming out for the relevant regulators and government officials to make the deal work for all parties involved, including Transnet. Yeah, just your comments on that, and particularly the comment, Roy, on making the Anglo assets work.
Yeah, look, that's quite a story, but I think Devin put it very, very succinctly. I think the first thing here is event risk is significant. This is either will he or won't he. Basically simple.
Yeah.
If it goes ahead, then there's a deal premium of some sort. Of what base, I don't know. If it doesn't go ahead, does the share price go backwards? So you have to go back to the beginning. What's the valuation? What are the assets looking like? What's management doing now? Once they get rid, they've already committed to getting rid of a few assets. What does the business look after that? Are they getting fair value for the assets that they're selling? And does that value accrue to shareholders? Those are the questions that you ask yourself. So then you're a comfortable holder of Anglos. If a bid premium does come, then you consider it and ask, do I want to be part of this ride? Do I want to be part of this thing once they're merged? Taking into account all the synergies and merger issues that may arise, then you make a different decision. As it stands right now, I guess, like the saying goes, the problem with the future is that it's so uncertain. You just look at Anglos and you say it's probably cheap, it probably has reasonably good assets, and we broadly agree with what management's trying to do in the interim. So sit tight, hold your shares and watch it. If you don't hold it, sit on the sidelines, nothing's wrong. Wait and see whether that bid premium is triggered, or if you want, look at the platinum company. So I don't think there's any incentive here for a knee-jerk reaction. It's all about valuations. It's all about what you think about the commodity cycle and where you think it's going to go, and how both Anglos and BHP fit in.
All right. Well, gents, let's cross on over to furniture. Lewis, is Lewis a buy, hold, or sell? Motivate me, please. Quite a plea there, Devin.
Yeah, this is a company I hate to love, but it's just done so well through the cycle. Incredible management team, really focuses on that true core business, which is furniture sales, and doing it with a lot of credit sales there, and you know, in what you could argue has been an incredibly hostile consumer environment over the last 5 years. They've just managed to continue to grow and gain market share and defend margin and just really do all the right things. So, I mean, it's not exciting, but it's incredibly impressive the way this management team does execute. You know, maybe the brands aren't the most exciting, but, you know, as an investment, my suggestion would be really one to look towards. And, you know, if you look at it from a valuation perspective, it's not demanding at all, even with kind of the performance it's had, and pays out a really chunky dividend yield historically. So, you know, there's a lot going for it. And I think, once you wrap your mind around the fact that it's just a furniture retailer, lots to look at.
It's quite interesting because, Lewis has stood the test of time. I guess a lot of people may be surprised that, you know, they're still coming out with the numbers that they're coming out, even in this constrained consumer environment that has hit a lot of businesses. Roy, would you say that Lewis is looking defensive?
For a long time, furniture retail was a swear word in retail. There's so many people who collapsed, went out of business, got bankrupt in that industry. This management teams maintained the same old office, the same old business strategy. When COVID came and everyone thought that they were going to go under because they relied on customers walking the floors to pay their installments, to buy more furniture, they turned the business around. Now I think 60% of the business is on debit orders, but people still buy they're buying back shares. They've evolved their product set. They bought UFO. UFO didn't quite work out. Now they figured out a way of restructuring it. These guys know their business. They're very conservative. They know that they lend primarily with furniture on the back of all that. Their clients pay them. They buy back shares. They pay a big dividend, and they're never aggressive about anything. Nothing to dislike about this company, I must say.
Yeah.
They've brought a certain level of respectability to furniture retailing, and all credit to them.
Looking like a steady Eddie there. Let's go into logistics. Please give me an assessment of Grindrod and Santova. Let's start off with Grindrod there, Devin.
Yeah, I mean, look, it's one that I think has some promise. I think it's done a lot of the right things recently. If you look at logistics in general, I think it's come out of a really, really tough place and well in the recovery as the supply chains open post-COVID. Again, this is one of those companies that doesn't have a demanding valuation. Call it a 10 price to earnings multiple, and it pays 4% in dividends. So there definitely are some attributes to it. You compare it to the other side of the equation, which you asked about, is Santova, which is very different, and where they don't own necessarily all the equipment, the property, plant and equipment there, and they're running kind of a virtual supply chain, and they've struggled a little bit more. So I think you've got to look into a lot more of the detail of this. I think generally when you're looking at global logistics as well, what we mentioned at the top of the show about the US elections and how that could affect global trade through tariffs and that type of thing will definitely be need to take it into consideration. But I think, you've got two companies that again, I think are managed fairly well. Both are actually pretty global. I mean, you've got Grindrod operating well into Southern Africa, Australia, and the East, through their marine transport, ports, terminals, that type of thing. And then Santova also globally with that kind of non-asset logistics. So, yeah, I think an interesting space. I think global trade's shape is changing, but I think there's still a demand for players who are nimble enough to be able to meet that.
All right. How would you be rating these two, maybe also just against each other in that logistics ecosystem?
So I guess the way to think of it is Grindrod is probably the anti-Transnet, effectively, asset intensive, and actual physical moving of goods through ports, managing ports and all of that. Whereas Santova is probably more global supply chain, software driven, exposed to international trade. They've got an office in the Netherlands and a variety of other places where they coordinate the movements of all of these things. Santova has gone through a whole cycle where it outperformed, then underperformed, and I think at the current point in time, earnings are going backwards. But that's just part of the cycle of international trade that they're going through. Nothing there says they're a bad company as such.
Okay.
Grindrod, on the other side, has benefited a lot from Transnet's failures as people have moved to Matola and other ports where they've actually made significant investments, and they've benefited. Remember, they came through a very significant restructuring which has changed the face of the business. Remember, they had asset management and a whole bunch of other things which they've sold. They've now focused on their supply chain and port management and freight business, and they seem to be on the rising side of that industry. So both of them are exposed to, well, I'd say Grindrod is probably exposed to growth industry in Southern Africa because of the failure of the behemoth, whereas Santova is probably exposed to global trade at a time when global trade is losing its shape, the way it has developed since the time of the World Trade Organization. So different businesses in broadly the same world, addressing the problem of moving goods everywhere. So I like both management teams. I think both have done incredibly well. You just have to be careful that they're highly cyclical businesses, Grindrod being more asset intense than Santova.
All right. Well, thank you so much for that insight. Let's get into Sasol. Every day there's a question on Sasol. Yeah, I'm wondering what stock is more traded than Sasol. Please ask the two gentlemen if Sasol is a buy right now, given Brent crude oil and chemical prices. I think for a long time the chemical prices have maybe been more of a concern, Devin.
Yeah, look, it's not pretty readings, Anatia. I'm seeing very little to get excited about with the stock at the moment. They had massive impairments they put through in the last results. The chemicals business in America, they're expecting it to be softer there. Africa, there's oversupply and reducing demand as well. They impaired part of the liquid fuel refinery at Secunda. And their outlook isn't particularly positive either. So, it's almost where does it end there? Again, this is also a cyclical company. And so, you have to take the swings with the roundabout. But this is a really tough spot for investors at the moment. And I wouldn't be picking bottoms. They had to revise their dividend policy, to show, how under strain potentially the business is. Cash generation is down. So you can hear, I'm trying to look for something positive, but yeah, I'm struggling. All to say that we have been here before with the share price at Sasol.
Yes.
There is the potential of upside, but there's going to have to be a lot of things in the market that change for that to capitalize.
Yeah, I mean, are you struggling the same to find to cling on to any positives or anything that could potentially trigger upside here, Roy?
Look, it's cheap. It's trading close to where it traded at the time of the pandemic.
Yeah.
It's 2.7 times forward PE. But that's just very little. This is a very complicated company. From a South African perspective, it's the only one that gives us direct oil exposure. But in truth, that doesn't matter because it also gives us massive ESG-related risk and actual terminal operations risk. That there's a point in time when some of the operations will have to be shut down or come to an end of life. So it's very difficult to price that. Put on top of that the lower oil price and the fact that the chemical cycle doesn't seem to be picking up this excess supply, exactly like Devin said. There's very little that makes you want to buy it because you think the share price is going to go up, except for the perspective that the share price is as low as it's been in a long time. So you could call it deep value, you could call it folly. It is cheap, but I don't see what moves it. Exactly like Devin says, lots of things have to go right for this one to work out. And in truth, maybe as those things go right, there may be other better buying opportunities. So the investor needs to gauge that. Do you really want to sit in this stock? Do you really want to make that one bet that's going to come through if 6 or 7 different things come right for the stock? I think that's a question that you think about. They're probably easier stocks to look at and come to conclusions about.
Well, something that might not be easy is deciding on your investment direction in the US with the elections coming up. Can the panel advise, should I enter the Satrix S&P 500 feeder or Satrix NASDAQ 100 ETF considering elections next month? Just on a broad point of view with the US elections coming next month, Devin, where should you be facing?
Donati, short answer, I don't know. I mean, I remember clearly when we had the last, I think it was 2016, Trump elections against Hillary Clinton. And there very much, she was the favored candidate, the market-friendly candidate. Trump was this, loudmouth maverick. And if he came in, markets would crash. He surprised the pundits and did get elected, and the markets rallied significantly after that. So, not only did you have to get the prediction right, but you had to get the market reaction right. And I think we're in a similar situation now. It's a very close race, probably too close to call at this stage. Varying policies, but those are all fairly known. And how will the control in the Senate look after the president is elected? There's a lot of complexity to it. So my sense is, as we were saying up front, expect volatility, but I wouldn't be binary positioning yourself ahead of this. I think if you are a long-term investor, US equity still warrants a place in portfolios. but I wouldn't be trying to tactically time this to take advantage of, US tech or, US large cap there. I think you need to use diversification to your advantage now. If you are looking offshore, then global diversification, not just US, although that will have a large weighting. So I think what I'm trying to say in the long answer is, I don't know, but don't be taking any rash bets on an outcome that is just unknowable.
It's quite interesting because, I mean, this question is based on the S&P 500 and the NASDAQ, and I would imagine that maybe there isn't a lot of difference in them considering the influence of the tech companies in both bourses. Should the U.S. election, Roy, have any weighting in terms of your, I guess, decisions on tech in the U.S.?
I think the thing to start off with is markets are forward-looking. The bets are being placed now, and I very highly doubt there's anything that you could do right now to take a bet on completely divergent views on the day of the election. Yeah. Effectively, I think exactly like Devin says, event risk is absolutely everything. You could be right, you could be wrong.
Yeah.
I think you have to look through, and on that day, there are going to be different influences. An outcome could come and short covering means the market rallies, or another outcome comes in and option trading pushes the market up. You may be right for the wrong reason. So it's very risky to place your bets on an event. I think what you need to look at is to understand that regardless of who wins, the biggest problem in the US right now is the budget deficit and the debt. Both of them are saying, whatever they're saying will result in a higher budget deficit, increased debt. That's why bond yields are rising. So if you're comfortable with that, then you take your bets understanding that what you're effectively saying is that interest rates will generally be higher, inflation will probably be higher, and the US economy continues to run that way. So I think that cutting a long story short, event risk is the hardest thing to bet on. Rather have a diversified portfolio, sit on the sidelines when there's this much volatility, let the event happen, and invest on the basis of the medium to longer term.
All right. Well, gents, let us get to something that is maybe easier. That's your stock picks for today. Devin, what are you choosing?
I am actually going US equity, and it's something we chatted about before, Zanati. It's, a lot of people have been looking at the Russell 2000 index, which is great, and we've held it in our funds before. We've recently replaced that with the S&P 600 small cap ETF, code SPSM. And what we like about it is it holds 600 US small caps, but one of the key criteria for it to make it into this ETF is that the company must be profitable, whereas that's not the case in the Russell 2000. So long term, this is a great outperformer of the Russell 2000 index. And what we also like, we think it's important to have exposure to US equity, but this gives you the opportunity to reduce the concentration risk to large cap US tech that you often carry in the NASDAQ specifically, but even as you said earlier, the S&P 500. So yeah, S&P 600 small cap ETF.
All right. What are you choosing on your side, Roy?
I think there's still significant value domestically. So I'm picking Premier Mills. It was only listed about a year ago. However, it's been around for over 100 years. They just make bread, and they've got a groceries business as well. But the beauty about their bread business is that they were typically based in the Western Cape. Now they're refurbishing all the equipment in the northern regions in Gauteng. So they're going to increase their efficiencies significantly and be able to take on the big market leader here, which is Tiger Brands. And you'll see that benefit coming over the next couple of years. I think for the top line growth that you're most likely going to see here, the valuation remains undemanding. It's a very strong management team who's got a very solid vision for this business. And I think for the duration that it's been listed, this is a company that you want to see growing over a period of time. So that's my pick for today.
All right. Thank you so much for your time and for your analysis today, gents. I'm sure the viewers do appreciate it. That is all for tonight's Stock Watcher. Thanks to our guests, Roy Mutooni from Sanlam Investments and Devin Shutte from the Robey Group. Up next, The Close. Stay tuned.